So welcome everybody. I am coming to you live from our new Troy office, and it looks this good. No, I am in Troy, but this is just a backdrop. But the office is that beautiful. You ever get in this area, drop in and check it out between 9 and 5. Just a wonderful location for us. Crooks Road, right off of 75. Anyway, today, FinCEN. I think that's the way they're properly pronouncing it. I don't know. John, you can give us clarification for that.
Yep.
John Bommarito is, and you can correct me, John, but I believe legal counsel for ATA National Title and their family of companies. He's also served in high positions on the Michigan Land Title Association. Did I get that right? Title
Yep.
Association, something of that. That means he knows a lot of stuff. So I don't know that we could get a better person to actually give us the introduction, the clarification, what to expect with this financial crimes enforcement network stuff and what it really means to us. So, John, it's all yours.
All right. We're going to go through the rule today. You may see a little bit of commotion here. I've in our office who haven't yet to come in and sit down and do that, but in fact, some of them are coming in now. We're going to talk about the rule today, and then ask any questions you want while we're going through. I may get some from the room, maybe I don't. But we're going to go through this. I'm going to open with, we don't want to do this. That's going to be our theme for the talk. This is a mandate from the Department of Treasury that we don't have a lot of control, have to comply with it. If you guys have questions while we go through this, I'm not managing it, so Darwin, if somebody can quarterback, interrupt me if there are questions, or read them out of the chat.
I'll have your back, and I'll watch for the chat room so I can bring them up at the what we call appropriate time.
Very good. All right. So FinCEN, this is the FinCEN AML. That stands for the Financial Crimes Enforcement. FinCEN is of the Federal Department of Treasury. AML stands for anti-money laundering rules. So the centered around combating money laundering. That's where we're driving. This affects or will affect closings or closing on or after. So the purchase agreement that you entered into today or yesterday or last week could likely be affected, because this is not when you sign the purchase agreement, or it's not when we open the file, it's when it closes. The rule, and I'm going to sort of read the rule, and then we're going to break down. There's 3 components to the rule. We'll put each of those down. We'll talk about what they mean. And then we'll go through some other topics. So the FinCEN rule impacts all non-traditional financed purchase transactions of residential real estate in any state higher is a legal entity or a trust. So again, all non-traditional financed purchase transactions of real estate is a legal entity trust. Now, the rule requires us as the settlement agent to collect and report details of that transaction to the Department of Treasury. Let's break down the definition of each of those components. Well, residential real estate is residential real estate. That means existing 1 to 4 family houses. That means co-ops, condos, could be mixed use or apartment buildings. The catch here is it also includes vacant land intended to be used for one of those things. So that's the definition of residential real estate. It's what we would traditionally consider, but also it includes vacant land intended to be used for residential. A legal corporation or a trust Those are primarily what I think we're going to be dealing with. So the buyer has to be one of those things.
John, just if I could real quick, there's a little bit of choppiness in your audio. So I don't know if
I'm hearing you
might
guys
have
just
to get
fine.
closer.
You're not hearing me?
Yeah, just it drops out a little bit. And I think there was an important part right after you clarified the meaning of the residential real estate.
Yes. So residential real estate is what we would consider 1 to 4 family condos, co-ops, houses. It also includes vacant land to be used for one of those purposes. All right. We're good there? Okay. A legal entity. LLC, partnership, corporation, trust. To be one of those things. Okay. A non-traditional finance is where it gets a little confusing. That does include cash sales. That's an easy example. Cash is a non-traditional finance transaction. It also includes any sort of seller financing. So private lender, land contract, seller-backed mortgage, all of those things are considered a non-traditional finance. Non-traditional also includes pulling money out of a HELOC that is secured on a different property than what we're dealing with here. With me so far?
Yeah, it's still a little bit choppy, but there was a clarification. If you can go back to the 4 things.
Cash, seller-backed financing, land contracts, private money lenders. Good? Okay. You have to have all 3. So this is not a rule where it's or. This is a rule where the transaction has to have all 3. So the buyer needs to be an entity. It's got to be residential real estate, and it has to be non-traditional financing. If any one of those is not present, the rule doesn't apply. We don't have to report. So you got it's an aim. The final component here is it involves the transfer of ownership of residential property. There is no dollar amount on that transfer. So a transfer for $1 to a buyer that meets the rest of the criteria will trigger a reporting obligation. That obviously has a wider impact than just transactions that you all or we might work on, but you get the idea. There are some exemptions, not very many, but there are some. Transfer incident to a divorce, a transfer incident to a court order, a transfer incident to a bankruptcy order, something from the death pursuant to their will and stuff like that, which that can be subject to interpretation. The one that I think you'll see most often is a transfer for no consideration by an individual to that individual's spouse's trust, individual or the spouse set up the trust. So if you're conveying for $1 to a trust that you created, there's an exemption. If you're a successor trustee, so we're conveying to mom's trust and mom's incapacitated and I'm the successor trustee, that is not exempt. That's reportable. Got me? Okay. That was basically the list of exemptions. You'll notice that there's some ambiguities here. There's not a lot of FAQs. We're going to get into those in a minute. So that the details from this rule are still sort of being clarified for us. We've asked a lot of questions. We have not gotten a lot of answers. So some of this is going to be a trial by fire kind of exercise. For our group and for our purposes, we're going to do our best to interpret some of the ambiguities and the areas that are unclear in line with the spirit of the rule and what we think they intend to police. The report that we have to file has to be filed in 30 days after closing or the last day of the month following the month of the closing. So, for example, you close on March 15th, the report to the Department of Treasury is due no later than April 30th. So that's the timeline we're working under. Who's got to submit it? Well, there's a hierarchy of who's got to submit the report. That there are 1, 2, 3, 4, 5. There's 7 potential people that have to report. 6 of them are us. So there's not a lot of wiggle room for us to get around that. But it's the person or the company who's listed as the settlement agent on the settlement statement. Okay, that's us. The person or the company that prepares the settlement statement. Yep, that's us. The company that submits the documents for recording. That's us. The company that issues the owner's power. That's us. That disperses the greatest evidence. Us. The company that provides an evaluation as to the status of title. Us. The company that prepares the deed. That could be us. So you can see, like, even if we're not doing all the traditionally do, they're still going to put on us to report something if we know it. That's what's going to create some friction. Now, the rule, the 3 components, remember, non-traditional finance, residential real estate, and the buyer is an entity. The rule is triggered by the status of the buyer. I don't care that the seller is a trust. I don't care that the seller is an LLC. We're going to get a little bit of data from the seller, but what their status is not what the Department of Treasury is trying to police here. They're focused on the status of the buyer. So the amount of data that the buyer is going to have to submit is much more than we want. Much of it is data that we don't need to perform the services we don't want to have because it's NPI. There's a lot of reasons why we really don't want this, but we're being given this task anyway. It's 5 pages. We actually have a sample form that Cheryl can share with you, should you so choose, but it's about 5 pages worth of data, which is a lot. They're asking things like the closing date, who the reporting person is. Of course, that's us. The property address. They want the legal description. They want information about the transferee, which is the buyer. They want persons associated with the transferee because it's an entity. We're going to have to drill down to there being a person. They want a little bit of information on the seller. They want the purchase price. They want the payment information, particularly bank information, at the details of the source of funds. Because again, we're policing money laundering. So they're really looking at tracing the money. So in a nutshell, that's a lot of it. We have to retain that data for 5 to 7 years. I think 5. That said, one of the benefits for the rule for us is unless we have reason to believe that the data on the form supplied to us is false, we're allowed to reasonably rely on what we're given by the buyer or the seller. An easy example is no one's social security number is 999-99-9999, right? That's not reasonable for me to rely on. That said, if it looks like any other collection of digits that looks like a legitimate number, we're not going to go run that through the SSI database to confirm the validity of the social number that somebody gave us. We're not going to check their birth date. We're allowed to rely on what they put down on the form. Now, our process is going to be the closing will not be scheduled until the buyer completes that form. The reason for that is twofold. One, unlike a 1099 where we've had some success in getting some of that data post-closing and cleaning up some of that administrative stuff, this is a lot more data. And our success rate in cleaning this up post-closing is not likely going to be the same percentage that we're experiencing. It's going to be a lot harder to do that. More importantly, the fines and the penalties associated with the failure to follow the rule are significant. The first violation fine is $1,400. From there on out, it goes up into six figures depending upon how many fines or how many violations you have. If you are found to be grossly negligent or willfully not following the rule, then you're looking at 5 years jail time. So given the severity of the penalties involved is another reason on why we're going to need the data up front before we schedule the closing. That said, a little bit about our process. We're still hammering out some of the details, but our process will look a little bit like this. We're going to centralize the processing of this function with a dedicated group and a dedicated person in Farmington Hills in our headquarters. So that means there will be a person that this is their job, is to comply with the rule, make sure we're all complying with the rule. We will work with the branch and work with you all, and really more importantly, the consumer, your customer, in the collection of data. We're going to utilize the services of a third-party vendor who does this full-time to help us collect the data in an efficient manner and help us file the data with the Department of Treasury in an efficient manner. All of this will be done to sort of speed up that process to get everybody to the closing table just as soon as humanly possible once we receive the form back. One of the questions I always get is, well, how long will this delay the closing? And my answer to you is, well, that depends on how long it takes the buyer to complete the data. Once we get the data back, it's a really quick turn. It's probably about 24 hours-ish to make sure that we can rely on the form. And once we can, the branch will be given the green light to go ahead and schedule the closing. But if it takes the buyer a week to fill out the form, that's not something that's within our control to be able to handle. Second.
Hey, John, let me catch you just there real quick. One would be, who's going to be wearing the orange jumpsuit if there's jail time?
Me.
So you're really talking, the trouble is not necessarily for realtors.
Correct.
But for us, it's going to be as realtors to get our people to complete the information they're going to receive.
Correct.
And how will that come? Will that come directly from the title company? What's the best way that we're going to have to work with our title partners?
So the way that I envision our process and the way I think it's going to go is we're going to do our best to use an electronic method to collect the data, something like a DocuSign, but it's not DocuSign. It'll look like that. You'll get an email with a link in it. You'll open up a form. The buyer will get this. The buyer will open up the form. They will input their data. Every field will be a required field. So like DocuSign, you won't be able to submit the form without putting in your birth date or your social number or the address or whatever, right? Your bank information. Once all those fields are filled out and the form is submitted, it will be transmitted to us and the vendor for us to review, make sure everything's straight. There's no glaring issues that we can't hide behind the reasonable reliance standard. And then the green light will be given to close. In a perfect world, everybody's able to do that. Recognizing that we all have customers that may not be as sophisticated with technology in order to handle that, we are coming up with a couple of other options on the menu, if you will, to figure that out. One of those ideas is you might be able to come into our branch. We'll have a terminal in one of the closing rooms where you can work on it there. I want to avoid, as sort of a last-ditch effort, I really want to avoid we filled it out by hand in paper and then gave it to someone to key in for a lot of reasons. One, and we see this all the time on 1099s, is that a 9 or is that a 4? I can't read your handwriting, right? That creates one problem. Whenever you give somebody something in paper and then someone has to key that in, you now got a data entry risk where maybe it got keyed in wrong. Now that's a whole other problem, right? So the more of those kinds of steps that you put in, the longer the process takes and the more prone to errors the process is. So we're going to do our best to come up with some options for folks that aren't as comfortable or able to do the link that's emailed to them and just get it done. One of those is going to be, hey, come into our branch. We'll facilitate, we'll have a station there and facilitate how that goes out. We're open to other suggestions. If somebody's got a great idea on another idea that might work, but that's sort of the direction we're going to have. We do want to have some options for people.
So what I'm hearing for us as agents, we need to get a bottom line transaction to the title company as soon as possible so that you can figure out whether or not this applies.
Yep.
And then that we can assist you in getting that
Yep.
information.
Yep. We're going to
How will
rely on,
we,
like we do for a lot of things, we'll need contact information for the consumer, the buyer, right?
yeah,
So, you know, and your knowledge of both educating them on if the transaction looks like it's going to be affected, how that's going to play out from a timeline standpoint, but also if they're debating on doing some things, what that could do. So, for example, if I sign the purchase agreement as a buyer individually, the rule wouldn't be triggered. But if, say, it's a rental property and I show up to closing and I created an LLC and now I want to do the addendum at closing to really buy it with the LLC, well, guess what you're not doing that day? You're not closing that day, because by doing the addendum to make the LLC the buyer and it's cash and it's residential property, you've triggered the rule. Now our group will tell you, we got to stop. You're going to get an email. You're going to have to fill out this form and we'll reschedule the closing. The reason for that is what they're asking you for is not stuff that everybody's got readily accessible. They're going to have to go look it up. I don't know anyone that knows their bank routing number by heart. I don't know anyone that even knows their bank account by heart.
mm-hmm.
They're going to have to go get some data together. So it's not as simple as just doing a couple extra pieces of paper at closing and maybe we delayed it an hour on a Friday. You're going to get rescheduled. But the knowledge for you all of understanding that if that happens at the closing table, we're not closing, is something that's going to be valuable for you all in terms of managing your customer and that end of the transaction, which, by the way, is also true if you got to manage the seller and they're expecting to close and the buyer walks in with this sort of addendum, wants to do this thing. It doesn't mean the deal's no good. It just means you're not going to close on that day, right? So there's a recognition to that process.
So here's a good one. How will we know that, I guess really two-part, I'm going to add to what they put here. How will we know that it is one of those that meets the rule, and how will we be notified that the buyer should have received this email to complete the information?
You'll receive that from the branch. So whoever you're used to working with at the branch office will be where they may know you get the PA. Like if you do, and it's a cash deal buyer and they know it's a house, they're going to tell you out of the gate, hey, this is going to happen. If there's a switch later on, at that point that they figure it out, or we at corporate tell them, hey, we got this, you have this transaction, it's triggered the rule. We're going to communicate with you all as the agents and with the buyers and say, this is what we need. So there will be a notification that the rule, this transaction is affected by the rule. Okay. So everyone's sort of aware. Let's put a ballpark on this. We ran. So there was a predecessor to this rule. Here's a little history. There was a predecessor to this rule that they called the GTOs, a Traffic Targeting Order. It never affected Michigan, but it did affect other markets across the country. So, of course, like New York, New Jersey, DC, Miami, Dallas, San Francisco, bunch of other ones. One of the other ones was Chicago, and we have operations there. So our Chicago operation has been dealing with a GTO 7 years now. And we run the into our production software of this rule and kick out a report of about how many, based on last year's file closings, how many transactions were going to be affected. We're probably plus or minus 5% for this rule. Wow. So, it's not one of those that, oh, good Lord, it's going to affect 45% of our transactions. No. Probably much lower than that. And I do think there will be a difference in markets. So, for example, areas where there is a higher usage of trusts and LLCs, like a Petoskey or a Harbor Springs, probably will have a much more disparate impact than, say, something in, Trenton or Flat Rock. Where the buyer type is different. In Chicago, they like to use a tool called land trusts to attempt to avoid transfer tax. Well, that may avoid transfer tax triggered this. So, but because frequency with which you now problem, you've triggered this rule while you're seeking to avoid something else.
Cool.
It'll
Hey,
just
John,
sort of make
I'm gonna have, it sounds like, I need you to get right up to that microphone again. That's where you started cutting out.
okay.
So, uh, a couple more that have popped up here, I think are still at the appropriate time to be answered.
Sure.
Um, if a real estate agent were to know that money was being laundered, what would happen to that agent?
You got a host of problems.
It's not only that agent, but this brokerage.
Yep.
Uh,
Yep.
so
And I would
bottom
encourage you
line
to go
is
talk to a criminal lawyer right away.
yeah. So run, don't walk away, run away if anybody you know, get away from that transaction.
Yes. So if anybody's seen Ozarks or if you've watched Narcos or any of those kinds of shows, you understand that there's an element of truth there in terms of what the Department of Treasury is focused on primarily is money laundering from drug cartels. They don't count it. That's the cash that their goal is to figure out how to get that cash into the financial system. And so the history behind this rule is they had prosecuted criminally a member of one of the drug cartels, higher up. Part of his, whether you want to call it plea deal or sentencing or whatever it was, involved a disclosure of how they were washing their money. One of the ways that they're doing that is finding straw buyers and injecting illegal cash into the, then takes it and house with it. 2 years later, flips it. But when they sell it, the money stays legitimate bank account that's used by the cartel, but now the money's been cleaned. So even if they take a loss on this, they took dirt, made it clean in the system for them to legitimate purposes. So it's the funding of transactions that matter. Now the other component to this is,
go ahead.
The other component to this is FinCEN believes that their GTOs that were in place before this rule were 70% effective in combating money laundering. I don't know what they're measuring that on. I don't know what the metrics to determine a 70% success rate are. That doesn't mean there aren't any. It just means I don't know what they are. They're not in the FAQs and they haven't been disclosed anywhere in anything that I've read. But the fact that FinCEN believes that they have that high of a success rate is why we're now dealing with a money laundering rule nationwide.
How long do we think it would take for this buyer to complete the information? Is it an hour on the computer? Is it 30 minutes?
You know, I mean, look at I myself, probably 30 minutes or less.
Okay.
But
bottom line is that then we shouldn't wait to get the information. It's going to be more of the point of agents make sure it gets done and knowing it's, call it an hour or less.
yeah, what do you want to say? A little bit of task management, a little bit of client management, right? Like making sure that they don't forget to do it. It's going to be a PITA. People aren't going to want to do it. It's going to be bothersome and cumbersome, and they're going to have to go home and look up certain amounts of information. Just get it. The sooner they get it done, the sooner everyone can move on.
Makes sense. So, is what do I say? Well, here I'm just going to ask the way that it's written here. How can money be laundered through us as a transaction? Is there anything as real estate agents that we can do to watch out for that, or should we?
You know, that I'm in a position where I don't necessarily want to give certain advice, but
I get you.
You know, it comes down to how the money's moving. So think about it from the lens of how the money's moving, which is why we probably have a much higher burden under this rule than anybody, because the money really moves through our escrow accounts. That's why FinCEN is focused on it. And they're actually probably tracing the money through our escrow accounts, but back to where it started from, because that's where they're headed, right? They're tracing the flow of funds. If funds aren't flowing through your brokerage account, it probably isn't much concern for you all.
So how will this impact cost to the seller?
I'm so glad you asked. Probably not much cost to the seller. There will be a charge, a separate line item on the settlement statement. And like a lot of other line items, the parties can negotiate who pays for it. We don't really care. Absent a specific instruction, it'll probably be assessed to the buyer because this rule is so buyer focused, right?
Mm-hmm.
Um, and so everyone has sort of an idea of what our industry is facing. FinCEN's estimate on the cost of this rule to our industry, $500 to $800 per file. They also estimate that it will take an employee 150 minutes of time per file to comply with the rule. That's FinCEN's own estimate. Now, when I say that there's going to be a charge, are we charging $800? Not likely, right? That you know, what we're going to do is put pencil to paper and figure out what our costs are, and we're literally going to pass through the cost, right? If I had to guess, and we haven't done this yet, I think you're probably looking at something between $250 and $500. That's a guess. The reason it's going to be a separate line item, say something like fee or FinCEN compliance, to that effect, right? It'll be somewhere in there on the settlement statement. Is, as I opened with, we don't want to do this. We're being made to comply with this rule. And as you've just heard, the cost to comply with the rule is significantly burdensome. So when the consumer has to that fee, when the answer, go call your congressman. Because we've tried to lobby the Department of Treasury about this rule for a year and a half or more now. One of the national underwriters has actually filed suit against the Department of Treasury over the rule. None of that stuff is working, and so we're still being made to comply with it. And at the end of the day, the more consumers that the Department of Treasury and that Congress can hear from that are upset and impacted by this rule, maybe the more they'll pay attention to revising it.
Makes sense.
So yes, there's going to be a charge. I just don't have a final number for you on what that is.
Well, and frankly, to be expected, especially when you hear that part of it. Hey, how about a 1039 exchange?
A 1031?
1031, yes, thank you.
Yeah, not impacted by the rule.
Okay. All right. Well, that's all the questions that I got here right now.
Let me do this for you. There are 7 FAQs. So you can tell there's not a lot of FAQs that we've been given, but here are the 7, and we'll go through those really quickly.
Perfect.
Question: how about gift funds? Would we have to report those? Answer: depends on the transaction and how the buyer is obtaining the remaining funds to purchase. If the remaining funds to purchase are coming from a bank that has an AML program and an obligation to report suspicious transactions, then this would not be reportable. And so that's sort of, think about your traditional lender: Chase, Wells Fargo, PNC, Rocket Mortgage, UWM, all the ones that make loans all the time that are going to have compliance programs in place. If the buyer is putting, even if the buyer's an LLC, if they're putting 20% down, but 80% is coming from Chase Bank on a mortgage, it's probably not reportable, right? There's an out there. But if the remaining fund purchase are coming from anyone, so mom and dad, kids alone, that's reportable, right? Question: what if they pull from a HELOC to pay for the cash transaction? Seems reportable since the mortgage loan is secured against a different property and not the property being acquired. What about when mom and dad finance the purchase of a home? Provided the other components are met, it's residential property and the transferee is an entity or a trust, this seems reportable since it's unlikely that mom and dad have an anti-money laundering compliance program. What happens if property is sold on a land contract or for a deed? Is that reportable? It's reportable since it's being financed that does not have an option in a compliance program. And again, all the components potential buyers and entities, that kind of thing. If we have a tiered entity, is it safe to assume we need to drill down to humans involved? And so everyone's aware, a tiered entity is you have an LLC that's owned by an LLC, right? Or you have an LLC that's owned by a partnership or a corporation that owns an LLC. You have a structure, you have multiple structures in place. They're going to make us drill down to a person. What isn't relevant to get is you might, hey, a year ago or a year and a half ago, there was that BOI, that business owner information rule for the Corporate Transparency Act. I filed a report with the Department of Treasury under that for my LLC. I have to do it. Yes, you do, because this is the Department of Treasury doesn't consider that when taking this is by property and not by entity, right? What if? Well, we just answered that one. If there are multiple legal entities in the transaction, what do you do? Well, if multiple entities are involved, reporting requirements apply to each reporting required transferee. So that means if you have two LLC buyers, they're each getting 50 LLCs reportable. All the other stuff's there. You have an individual and only the part that's the LLC is reportable, the individual. So they're gonna splice it out that way. And the last one is, do you think FinCEN will expand the scope of reportable transactions to commercial properties? And the answer is, why wouldn't they? If they're successful at catching bad guys, why wouldn't they include all property types? So that's it in a nutshell right there.
Sounds good. And I think, John, you said as far as how prevalent these types of transactions are, was about 5% is what you guys found?
In our file, yeah, we're going to estimate % of our file load company-wide.
All right.
Fluctuation.
So oop, we lost you right there.
There'll be some fluctuation based on market, right? Like, so if
Right,
you're
yeah.
in a predominantly individual buyers, they aren't using LLCs or trusts, then you won't hit 5%. Could be the other way. If you're all trusts and all LLCs or a lot of that stuff, then maybe you're more than 5%. It's going to depend.
Yeah, so I think so if I simplify what I'm hearing, it's cash, land contract, those would be the two most common for us. And going in the name of a LLC or something else other than individual. Is that simplified what we would worry about as an agent?
Yeah, you got a number of off ramps here, right? So if you look at this as like a flow chart or more of like a choose your own adventure kind of thing, you got to have all three, right? Residential property, buyer is and they use the word transferee. The transferee is an entity or a trust, and it's a non-traditional finance, meaning cash, land contract, something like that. You have to have all three. If any one of those are not present, the rule doesn't apply. So it's an all or nothing kind of thing.
That really brings in the KISS principle for this with us. And then what would be the conversation that we have with the transferee buyer when we even suspect that this is possible? What should we prep them for?
I didn't get that.
Well, I guess so I get somebody who's going to buy one cash. They're going to put it in an LLC. It's a residential single family home. I can rest pretty much assured that FinCEN is going to be there. What would be the conversation I should have to prepare the buyer for what's to come?
Hey, there's going to have some data that you're going to be required to report to the government on the transaction. Be prepared to do that.
Keep it simple.
Yeah, keep it real simple. It's a governmental requirement. The title company doesn't want to do it. You're not going to forum shop this because our entire industry has to follow this rule. So this isn't something that just putting in place. You're not going to find a different answer with a different title company. These are federal rules that affect all real estate transactions, of this nature. So they're all
speak
going to do that.
frankly and just let them know this is about trying to catch the bad guys who are trying to money or do laundering of money.
Correct.
Just again, I think that's all of this is really what I'm catching is it's pretty simple for us. So let's see. The rule starts March 1st. So any closings that could occur is March 1st. If
Yeah,
it's
so
the
I would
closing,
encourage you to look at what deals you have in the pipeline right now. Look like they could close at first and see if they are impacted by the rule. By the way, our branches are doing that now. They're going through their open files, and they're going to be now proactively on deals that they think could be impacted by this. But I would also encourage your group to do the same thing.
yeah, and Prasanna, for your question here, yeah, John said most likely we can anticipate that all of the closing companies, title companies, would be adding a charge to the buyer side because of who it's required of. And then let's see, is there a place where or a document that we can read about this rule? Where would we find to kind of review what you've given us today?
What kind of documents? I mean, like a sample
Yeah,
form?
like is there a flyer, an information sheet, something
Yeah,
of that?
Cheryl has some marketing information that she can share with the group. And then if you'd like to see a sample data collection form, and I will put the disclaimer out there that form is not finalized yet, because if FinCEN decides to change the rule that form or what we have to reflect, then that'll change. But you can get an idea of what we're going to be looking for by looking at that too. So we can give you any of that stuff. But yes, we've got some marketing materials.
Sounds good. Sounds good.
Last thing I want to mention, you can yell at me. Don't yell at the branches. The ability to do a courtesy deed or the ability to do even a courtesy recording is going to be impacted by this rule. So if a consumer shows up in our office with a deed from themselves to their LLC, even if that's for $1, triggers the reporting requirement for us. And the issue is we now have knowledge. So by recording that, it's also going to require us to do a reporting to the Department of Treasury based on the rule. What people do outside of closing, I'm not here to police. I haven't been deputized by the Department of Treasury. But the rest, that we prepare a deed or that we even record a deed that could trigger reporting, you're going to be told either we can't do it, or if you really want to do this, then you're going to have to pay the fee and fill out the form, and we're going to have to file a report on your behalf.
So this actually then brings up an interesting question or scenario. Can a buyer just do this? Can a buyer seller do this on their own and bypass the rule somehow or the buyer buys it cash and then transfers it by themselves to their own LLC?
I mean, look, what people do outside of closing is not within the scope of things that I'm able to control.
Because we're addressing what settlement companies are to do. Yet there's that last one that you said, I think it was who's recording the deed?
Yeah.
Or prepared the deed. So whoever prepared that deed, if it was the buyer or the seller, in reality, they're responsible to make sure that the FinCEN is covered.
If we're not recording it, it's not our responsibility. But yes, it's certainly someone's.
Somebody by the rule is responsible for this if it qualifies to the rule.
Correct.
So
now,
I guess, yeah, Krista, then the answer is it could happen, but it shouldn't.
The other thing, one of the last things I'll say is I've had some people, they're gonna repeal this. It's not. No, that is not what the Department of Treasury is telling me. Given that they believe they've got a 70% success rate, they have no intention on repealing this rule. What they may do, and what I'd like to see them do, is really modify the rule and tighten up some of the parameters. So, for example, an easy modification that I do is, so 150,000 is not reportable. right?
Hey, John, you just broke up quite a lot there. It was where you were saying, where you were just starting with this point where we lost you.
The rule is not going to go away. What they may do is modify the rule. And so I'd like to see them put for example, I'd like to see a price floor. So anything under 100,000 or under 150,000 is just not reportable. And it makes common sense when you think about money laundering. No one's going to the land bank and buying $1,001,000 properties in an effort to launder money. That's not scalable. It doesn't make sense. It also would get you out of the estate planning realm, the deed in and out of the trust or the deed in and out of an LLC, just because maybe a bank doesn't want to loan to that entity, but you planned that entity for, liability purposes or whatever. It would eliminate all of that sort of nuanced stuff. And that they put files in like that, they streamline this and further shrink the number of files affected. But rest assured, I don't think the rule's going away.
Makes sense. Makes sense. Well, guys, a quick Q&A is where we're at. Feel free to take yourself off mute, ask any question.
I have a seller and he puts all his properties in an LLC in the address of the property he's selling. So that's all reportable?
No, this isn't triggered by, we don't care what the seller does. So the seller being an LLC or a trust, it doesn't trigger the rule. We're focused on the buyer.
So just so I have this right, if they are going through a bank or a 1031 exchange, that responsibility is negated by those entities?
Yeah, so if you're getting a loan from Chase Bank or you're doing a 1031, those entities already have obligations under the law to report suspicious activity. So when they're involved and they've got a compliance program, as long as they're funding the majority of the transaction, for example, it's not reportable.
So this is mainly for cash buyers, correct?
Cash, hard money lender, people who loan money but aren't Chase or some sort of conventional lending institution. I mean, that's fundamentally what you're looking at. Private financing. By the way, mom and dad, land contract, seller-backed financing, cash, hard money lenders, those types of things. Think about it in terms of, does this person have a compliance obligation? Meaning, do they have a policy to comply with Banking Act and a bunch of other stuff or not? And on your own, figure out whether that person that's going to kick money into the transaction has that obligation or not.
Right. Like when we bought our house and Fifth Third mortgage underwriters went crazy for 3 weeks over an $800 deposit we made, that type of thing.
Mm-hmm.
Okay, thank you.
Anybody else?
Can you one more time? I think I heard you say something about even like gift money. And so we're not just talking about if the whole transaction is cash. You're saying this could be also triggered by the down payment source.
Whether that's true or not depends on where the balance of funds are coming from. So that are giving the kids 20, but 80% of it is coming from a Wells Fargo mortgage. It's probably not reportable. And that are, and the buyers are tell Wells Fargo where the 20% is coming from. They're going to have to either have financial statements that show that, or they're going to have to tell them, hey, my mom and dad are giving me the 20% down and you're funding the other 80%. So now the bank would have an obligation to report that if that was suspicious. But if the gift funds are accompanying a land contract or a seller-backed financing situation or a hard money lender, then yeah, it is reportable. But it depends on where the rest of it's coming from.
Okay, thanks for clarifying that.
Yep.
Can you guys hear us here in Northville?
Yep, we got you, buddy.
Okay, John, on the flyer that Dawn dropped off yesterday, one of the third page, it says retention of data, that the reporting person must maintain a copy of the certification as the identities, as well as any designation agreement entered into for a period of 5 years. I mean, is that putting the onus on you to track whether they're changing whoever the beneficial interest is for those 5 years?
No, when they say designation agreement, it's if we're designating someone else to act on our behalf as the data collector and the submitter. You know, it has to do with some designate our under the statute that the consumers.
Okay. I mean, I just, because it says as to the identities of the beneficial owner of the transferee. I mean, that could change over the next 5 years.
Nope. Not.
So it's only at the time of the
screenshot in time.
Okay. Wonderful. And then I just wrote one yesterday that it's obviously an LLC as the purchaser. It'll probably close sometime in March. So assumption is he's going to have to fill this out as the buyer, correct?
Correct.
Okay. All right.
And then will you guys then be the ones sending out that data form to buyer and seller to fill? Or is it the agents then helping to ensure that that gets filled out with their clients?
I would ask and making sure, because you'll know when it goes, but we or our vendor really will be communicating directly to the buyer to say, hey, you've got to we have to file this report because your transaction meets the criteria. Please fill out the form.
Yeah, I always put it this way. When something goes wrong, whose fault is it? Look in the mirror. So yeah, we have to oversee. We know that everybody else has their stuff, but this is one where we know it's coming and it's going to delay being able to establish a closing until the settlement company receives that information. So yeah, we will need to be on top of it because it's going to be out of the ordinary. Jamie, are you guys set there? I see you're kind of, looks like you're good.
Unmute. Are we on mute? Hello.
Okay, there it is. There was a question coming.
There we go. On mute. Oh, now you're okay. Oh, can you hear us? Can you hear
Yep,
us?
you're good. Go ahead.
So I saw it's Dawn Payton. Hi there. I saw somebody ask the question about the seller, and when the buyer does not answer those questions, how are we protecting the seller to make sure that that's getting filled out? And is there a timeline so that the buyer, the seller knows to move on to maybe another offer if the buyer's not complying for that? Because the buyer could drag this out for how long? If we send them the 5 questions and we've done our part, but the buyer's not filling it out, is there a deadline or a time frame
That should
where
cover the financing.
the seller can say, well, you didn't do what you were supposed to?
Wouldn't that be in
That's
the
a question.
financing contingency portion?
Well, I'm gonna, John, you're hesitating, so I think that's more on us as a real estate side of things. And the answer is the purchase agreement.
Correct.
So somebody suggested either you put it on there or we're just going to have to stay on top of it. And there's a close by date. And then we're dealing like any other transaction. What if it doesn't close by the close by date? Well, we just handle it and it's situation by situation. And the funny part is I'm looking at it and going, well, the purchase agreement states something to the aspect of any delay to the closing due to financing. Well, there's not a specific time frame. So if you're really concerned about it, then add a brief clause to the purchase agreement. I can say, now knowing everything I know, look, there's a lot of stuff that buyers have to get if they want to buy a house. Go to a mortgage company. I always tell them you're going to have to jump through hoops. They have the money. Well, in this case, title company's got the control because they're not going to do anything until they get that done. So when they say jump, you just say yes, how high? And it gets done. So in my head, I'm just thinking from that direction, guys. I think this is going to be a keep it simple and just make sure that it gets done. That's really the key. And then look at the terms of the purchase agreement.
So instead of closing in 10 days, it could take up to weeks then if they don't fill out the form, the
Well,
buyers.
yeah, but how long are you going to let them go without doing that? And as a buyer's agent, look, you said you'd close within 10 days, and right now you're the party that's responsible for that not happening. Fill out the damn form. Do you see what I mean? It's just, let's keep this simple, guys. Keep it simple. Yes, it did. Close date is pretty far. Well, don't let the close date go down the road too far. Look, how long does it take to close a cash transaction? If we had pre-title, I think title company could close that in a week. They may not like it that fast, but if pre-title's done, all they got to do is do an update, put a name on it, we close. So,
Hey, Darwin.
2 weeks is the typical time frame for something like that. Yeah, go ahead.
It's Renee. Do you think
go
we
ahead,
could come
Renee.
up with a company clause and then we'll just send it out to everyone?
Yeah, I'm sure we can, but again, let's use the KISS principle, guys. Do you put a clause on there for financing? Yeah. Well, the clause for this is the close by date. Yes, but
We all know that
keep it
doesn't mean
simple.
much sometimes though.
Yeah. Well,
I think as a
yeah,
company, we need to just discuss it.
yeah, we'll talk more toward that, but right now, what I would share with everybody, John, am I off basis on this as far as keep it simple?
I mean, simply, I also think an element of clarity. You can be simple and clear. I think each transaction is unique on its own. So sort of assess who you're dealing with, what the other aspects of your deal are, and what pressures you're under. If there's a rate lock, if there's something else, you might decide on a specific deal that I need to be a little bit more specific and clear here that this is going to be done by such and such a date. Otherwise, I got the ability to walk because I got a rate lock that's going to expire. Or maybe you got a backup offer that has a rate lock that's going to expire and you want to take this one, but you're not going to be held hostage all day. So I think each situation is specific in terms of how you want to handle it. But I think that's on you all to sort of assess your client's needs, who you're dealing with on the other side, and what kind of clarity you think needs to be in the purchase agreement.
Sounds good. So, gang, I'll let you know that what I'll do, especially as we get more educated with this, but I'll talk with leadership and we'll see what the thought is. And if it's like, yes, we need it, we will create a clause that you can then drop into the purchase agreement. Okay, good stuff. Okay. Yes.
Obviously, you're looking at this to help protect us, and ATA I'm going to make the assumption that the Land Title Association's probably been working on this for months as well.
I've been out in DC for 2 years talking about this.
Okay. Well, I know they pushed it off last year because I had a number of clients.
It was supposed to go into effect December 1st, and the underwriter that filed suit in November was successful in getting the Department of Treasury to agree to an injunction March 1st, and so here we are.
Didn't they kick it to the curb originally, though, back in April or May?
They may have delayed it, but no, it was never going away. That was never their intention. I was actually in D in May, and that was never their intention to get rid of it.
Well, I know that wasn't the intention, but I had understood that somebody had taken the department to court, and
Fidelity did, and it was in November. It wasn't in May. It was in November, and that's what, because the rule was supposed to go into effect December 1st until like late fall. So they agreed to postpone it to March, but back in May, they had every intention of moving full steam ahead. And in fact, their answer to us in the room was sort of, we've already told you about this for a year. Like, we're not delaying it. So it really wasn't until suit was filed in late October or early November that granted an injunction March 1st, and where we're at today.
All right. Well, guys, with that, I want to say, John and Cheryl, ATA Title, thank you so much. We appreciate you and your time, guys. If they're in your branch, definitely take advantage of it. It's our best way of being able to say thank you. I really understand a whole heck of a lot more than what I did before. So John, great job.
Thank you.
And with that, guys, any final thoughts from you, John?
No, it will communicate does change with the rule, and I anticipate things might, but we might not see that for 6 to 12 months. So, you know, we'll do our best to communicate timely when things develop. And if you've got any follow-up questions, you know how to reach Cheryl. Cheryl knows how to reach me. We'd be happy to answer follow-up questions as they come in.
All right. Well, hey, you know the door's always open for these Tuesdays. So we appreciate you guys. Have a great one. And
Thank you.
everybody, you know what to do. Go out and talk to people. See y'all soon.